All right. Hello, everyone. Happy Friday. This is the Friday of a long weekend. So, just the fact that you were here, give yourselves a star and feel free to crack yourself, a cocktail or whatever floats your boat at the end of the day. Today is sponsored by the numbers 9, 6, and 5. And why do I say that? Well, because there are 9 trades I'd like to review. Some of them we're going to spend a little more time on. Some where it's going to be like a glance and we're done. We have 6 positions that we are now out of that we were in on Monday, some of them that we placed on Monday. I'd like to have a quick peek at those. And then, 5 new trades that we'd like to place. So we are going to be moving really quickly today. We're looking at trade management. We're looking at opportunity, and we're looking at when we might look at something and say, you know what, it looks delicious, but it's not fully baked yet, in that we don't have a technical entry and we have to exercise patience. And patience is one of those things, it's kind of like the word capiche. I remember saying to my son when he was about 2, capiche, do you get it? And he said, I don't like capiche, Mom. And I don't like patience sometimes either, but it is a virtue and it is an important thing to take into consideration in the discipline of our trading. So we've got a lot of the usual suspects here. I commend you for being here. If you are here for the very first time, please feel free to type a greeting into the chat so that we can welcome you to this community. But hello to Marcus and Sia and Will and Neil and Jay Richardson and Do Not Copy. I've not seen that handle before, and I got to say, I kind of like it. And Josh and Jay and Dee and Ben and Marcus and Chuck and Priya and the rest of the gang, thank you for all being here and bringing this class to life. If you are not following me on X, I think I have finally figured out, thanks to James Boyd, a way to manage all the spam that is coming with everything that I post. So if you would do me a favor, I posted something this morning about the long weekend. If you would respond to that so I can make sure that you guys can respond, but the spammers can't, I would appreciate that. But my handle, Barbara Armstrong CS. Connie Hill is also with us in the chat. And she's a friend and fellow coach and posts a lot of great content. So you'll want to make sure you're following Connie as well, Connie Hill CS. And just before we get into our 9, 6, and 5, know that we are going to look at a lot of option positions today. Those carry a high level of risk and aren't suitable for all investors. We'll discuss potential risks and rewards as we go through. We use the Paper Money software application on the Thinkorswim desktop platform. It is a brilliant place to learn, to practice not only your trading strategies, but to become familiar with the platform before you consider migrating to a live account. Know that short option positions will never be assigned early in Paper Money. We can discuss it, but we don't get to see it. That can happen in a live account. Okay, so when we look at the S&P 500, we're down again today, but the thing that I find encouraging is that we opened lower and we're now moving higher. We also had a previous resistance level here, that was hit back in March. And, we've come up kind of into that area. We broke through, and it appears so far today, and this is a live candle. Excuse me. Sorry, had to sneeze there. But this looks to be holding. So this still looks, if we're playing I Spy with my little eye, this still looks like a potential bull flag pattern, but it's not complete. And, this is just one way of looking at it. And kind of the same thing with the NASDAQ, right? So this came up, it is continuing to pull back, but could this end up being a bull flag? It could. And could it continue to fall? It could. We don't have confirmation either way. But again, when we have a candle like this, it opened lower and is trying, the bulls are trying, to overtake. Okay. Exert their influence. Okay. All righty. So I want to look at the VIX also. Well, let's have a quick look at the Dow. Oh, sorry. I just brought so when we look at the Dow, similar thing, right? Like, although this one now, we had a higher high and a low here, and this is a lower low, but could this be coming down to this kind of potential support level? And will it hold? Well, I guess we'll find out by the end of the day. We'll find out more on Tuesday. And similar pattern on the Russell. Now, one thing that I thought was interesting is that the VIX, the VIX went all the way back up to 25 and change this morning. So this is a big move on the VIX, a 10% move up. And that's kind of messing with some of our short put vertical trades, this bump in volatility. Also with our iron condor, it's giving, that volatility isn't helping. Okay, so let's go and have a quick look at Mickey D's. This is one of the ones that we wanted to manage. And so we had an iron condor. And if you are new to this whole world, and I'm hoping that my drawing tools are going to play nicely this morning. But when we look at McDonald's, and, we did this short call vertical. I think of this as a credit spread sandwich. So we did a short put vertical at the bottom, and we did a short call vertical at the top. And on, I think it was Monday, we said, hey, this is pressing up against our short call vertical. So we're going to buy back the short put vertical because we had the majority of the premium that we could enjoy out of it. We had the majority of our gain. Now this has pulled back down and it expires June 6th. So we still have 2 weeks to go on this, but it's kind of doing exactly what we wanted it to do, was stay, between, we want it to continue to hang out in this area. And so far, so good. Now, the one thing that makes us a wee teensy bit nervous is that it's spending a lot more time lately bumping its head up against the ceiling and, rather than going down and visiting the floor again. We'd rather have it head back to the floor for one more bounce. Yeah, so far it's not doing that. But as long as it stays below 320, we'll be fine. But when we come to our monitor tab, it's showing that we're underwater here by $39. But one of the advantages we have, so volatility is, giving us a run for our money, but we have 3 days of time decay when the markets are closed coming up. And so we might choose to close this out on Tuesday or Wednesday. Now, we meet on Mondays and Fridays for trading a smaller account. We're off for Memorial Day on Monday, so we will look at this again on Wednesday of next week. Now, so that's the first one in our trade management arena. There was another one that I wanted to talk about in trade management, SMCI, and I was thinking, hey, maybe we should sell another covered call, and we ended up stopped out. Now, when you're stopped out, often we look at that and go like, ouch, that means we must have had a losing trade. Not so fast. Let's go and look at this one. So if we come to the account statement and I bring up SMCI, now what happened with SMCI, we're going to come back. Oh, I guess we've got to come back more like 100 days. Okay, so what happened with SMCI is we sold a put. And so we said, hey, if it gets put to us, we're cool with that. And in fact, it did get put to us. But what did we make on the selling of the put? Well, we made $181. Okay, so we made $181 on the short put. I'm trying to go quickly here, so we'll just make S is short. So we sold the put. And then we came in because the stock was put to us at a price of $37, and we sold a call. And we sold that call for $296. We bought it back for 93. So, we ended up by how much with that? Well, 246 minus 93. I already did the math. So we sold a call. And our net gain on that call was $153. And then the stock was put to us at 37. We got stopped out today at 39.71. So on the stock appreciation, because we bought it at 37 and we sold it at 39.71, we were up 271 a share, or 271, for a grand total of 605. So let the banners fly and the bells ring out. That was a pretty massive win. And we had moved the stop up with the intent of protecting some of the gain. And that's exactly what it did. Now, was there money that we could have had by getting out earlier? Yeah. But, that's what we did. So that's how that one played out. So that one, not too shabby for something that got stopped out. Now, I'm not going to go into a lot of detail on these because we had 4 long call verticals that we ended up out of. So just to review these super fast, on Monday, and let's just go to 10 days. In fact, we're just going to review this trade from this week. So, we did a long call vertical. So we bought, and I'm just going to do the math on the first one, if that's okay with you guys. And then I'll review them and talk you through it. But maybe you can go back and look at this video and stop it. And if you're newer to calculating return on risk and net gain or net loss, you might want to stop it and kind of go through the math on the recording yourself. But we opened this one on Monday. It was a long call vertical on Meta for 260. And so how much could we have lost? We could have lost $260 a contract on this, and we did 2 contracts. And then we got out the next day for 340. So we just take our 340 and subtract the 260. And so what did we make? We made $80 a contract times 2 contracts. And so, we made $160. And you know what we call that? A base hit. So we're happy with that. But as a return on our risk, we made 80, and we could have lost 260 per contract. This is a per contract calculation. So our return on our risk, if we take 80 and divide it by 260, is 31%. And with these, if you go and look in the trade management mini session playlist, our example trading plan says we were looking for a 50% gain. And because we've had so much volatility in the market this year, we said, you know what, maybe what we do is aim for 25% instead. And so that's what we've been doing. And we've been finding that's been working nicely for us when something moves quickly. Okay. And so this was Meta. And, we got in on Monday and we were out the next day. Now, also on Monday, we did a trade on Google. And on this one, and I'm just going to talk us through it. So we got in for 290. How much could we have lost? 290. We got out for 375. So we made $85. And that was, when you take 85 divided by 290, that was a 29% return on our risk. And if we look at this, our goal was to get out at 372 or above, and we got filled at 375. Sometimes these are a bit of a paper money fill, but that's the way it goes. And then for VRT, we ended up opening 2 trades. We were going to do a long call vertical and a short put vertical. The short put vertical we're still in. But the long call vertical, we did 5 contracts because we were risking $95 a contract. We made 30. And so that was about a 30% return on our risk. If I take 30 and divide it by 95, and then, we made 150 on that. So another base hit, yay us, in our example account. And the last one was MicroStrategy. And MicroStrategy, again, we did short put vertical and a long call vertical. And we ended up out of both of those. And so this one, there might have been some weird volatility with this through the day because we got out of both of these in the same day. And because this is the first short put vertical we're reviewing today, so we paid $1.75. Sorry, we were paid $1.75 to get in. And so in a live account, this may not have played out quite this way. So this was the most we can make. And we bought it back for 45. And that happened the same day, which is pretty unusual, especially for a short vertical. But that was 175. We did 1 contract. We paid 45 to close it out. And this shouldn't have even filled, actually, because I'm looking at that and going, well, wouldn't our exit have been like 35? And our exit was 35. So this shouldn't have filled at 45. So this is kind of an anomaly. But just to walk you through how that math would look, we made $130 net on this example trade. But what were we risking? Well, we were risking $5 per share minus the 175. So we were risking 325. And so that came out to be about 40%, a 40% return on risk. But that was, a paper money, I would say that was a paper money hiccup, if you will, because if we look at the order history, my order said buy it back when it's worth 35 cents. So it shouldn't have filled at 45. So sometimes there are things, but people will ask, like, what happened to that trade? That's why it's no longer on. That's why it's no longer going to be showing. And then we did in another class on KHC, Kraft Heinz, we saw this bearish engulfing pattern, and we did a long put vertical on that, which is a bearish trade, and we were out of that pretty quickly also. So there's our reviews, done, 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 and done. Okay, let's go and place a couple of new example trades, and then we can come back and look at, there's a buy right that I want us to take some action on. And so it's not just a review, it's what I call a postmortem, it's something with action. So let's come and look at Palantir. So we looked at this one in after the close last night, but when we look at this and we say, well, we saw this kind of cup and handle pattern, and it's now kind of flirting with this resistance level, but from where I drew my line, it's not back above yet. But what we are seeing is a hammer, and then this pattern, this 2-candle pattern, is called a harami. And with a harami, it doesn't require confirmation in that the body of yesterday's candle was totally inside the candle of the day before. And it looks like it's been flirting between positive and negative all day. But if we looked at that and said, I could see this kind of maybe this 120-ish level holding, and it's sitting at 122. And others might say, yeah, I'm not so sure about that. it is definitely a more aggressive entry. But if we look at that and we say, well, it's a selling strategy, we've had this little bump. We've had this little bit of bump in volatility. If we come out 3 weeks, time decay will be working in our favor. We have a 3-day weekend ahead of us. And if we come out, we've got a delta of 41 here. So this is saying you've got about a 50-50 chance of this being in the money, 46% chance of it being in the money, 54 of it being out. And so you might say, well, I'd rather come down to this 118. And, you know, we could look at that too. So if we sell our vertical and we did a 118, say 116, we get 75 cents. So like, is that appealing? Well, the way that we look at it is we say, okay, we can make up to 75. We're risking $1.25. So if I divide that by 125, that's a 60% potential return on an investment will be in less than 21 days, because we're going to close it out prior to expiration, whether it goes for us or against us. And now this one has closer to a 60% chance. It's saying 42. So we've got a 58% probability based on where it is now. But this algorithm, these are calculated based on where the stock's currently trading. You know, it's not taking technical analysis per se into account. Okay. So if we come here and we say, okay, you know, if I look at this on the chart and I move this down to 118. Now, if you're not bullish on Palantir as a company, you might not want to do this. And June 13th. You know, but if you're thinking this might hold as a support level, we'd come in. Now, how many of these could we do? How much are we risking? If you don't want to do the math, you just come here, 128. So if we did 4 of them, that'd be in that neighborhood of 500. So that would be at 520. So if we're okay with that, we're going to right click. Well, we're going to come here, single order, make it first trigger sequence. Then if we say, okay, we want to close this out when we've got 80% of our max gain. Now, if we look at this on Wednesday and we've already got 60%, might we just close it out? Absolutely. Yeah. So we're going to make that good till canceled, confirm and send. Why is this not? And we're going to put that in our short put vertical group. Okay, so that's Palantir. Now, the next one I want to look at is Goldman Sachs. Now, I did a survey a week ago Monday, and I said, hey, you know, so we were looking at a trade, and someone had said, and it was on Goldman Sachs. We were doing a postmortem. And when we pulled it up, we saw that we'd done a whole pile of trades. In fact, we were placing the 7th trade that day. And somebody said, well, I wonder how we've made out in total. And so this is our wash, rinse, repeat, review, 7 trades and the one stock. This was Goldman Sachs. And when I did a survey, 98% of you said you wanted to see that. So here it is. It's under the trade management mini sessions. And then when you subscribe to the channel, I mean, you can just come and then do some binge learning. So the short put vertical trade we just put on, here's an example trading plan. The long call verticals we reviewed, here's an example trading plan. And you'll notice that this is just an example and that we, in fact, in this class have modified our targets of late on those. And then this is the session, you know, I'm working on these now. You'll see 7, 8, 9, and 10 probably next week. If things go really well, you may see 7 and 8 by the end of the day today. Okay, So, and then, this is why you want to subscribe, right? It's another free resource when you first get here. And what you'll see first when you come to home is what's currently being taught. Okay. Okay. So that's that. So back to our regular programming. Alrighty. So next one, well, why don't we look at Goldman Sachs? So, and here's another one. Now, what do I find interesting about Goldman Sachs? And it's saying here, we have a short put vertical on June 6th. If we come to our monitor tab and come to activities and positions, and we come down to short put verticals, we actually no longer have that position on Goldman Sachs, but could we do a new one? And could we, kind of maybe even move it up a bit and say, to maybe 570, 580, we're sitting at 598. So here's 580. So could we do 580, 575 maybe? And go out to June 13th? We can, alter this if that ends up not being, a good idea, or not, the juice isn't worth the squeeze. And, this candle, I mean, it did gap down today, but it's rallied pretty dramatically and is within 3 cents of being positive on the day. And that would be considered a bearish or a bullish engulfing pattern rather. But it is, well, you see now it's positive, but it is a more aggressive entry. And when you do enough of these, sometimes it's like, which rules you may, be more willing to be a little more lenient on. You may not want to wait until the end of the day when you've got that confirmation of that bullish engulfing pattern which is essentially establishing a new support level. So could we come down here to 580? We've got 74 contracts, a 30-cent bid-ask spread, a 35% probability. So this is statistically a more appealing entry than Palantir, in that you have a 60% from where it currently stands. Now, it could be different by the end of the day. But could we look at 580 and 575? Well, we could. So we get $1.45. It was a little more earlier this morning. So we're risking $3.55, right? $5 minus $1.45. So is that worth it? 145 divided by 355. Well, that's a 40% return for a trade we'd be in for 21 days. Our guideline is if we're in it for 21 days, we want at least a 21% return. That's almost double that. So that's interesting. Now, you may be saying, like, what's with the 21 days with Barb? Like, why are we not going out 28 days? Well, let's see how much more premium we'd get if we went out another week. So 30% more time. Are we going to get 30% more premium? Okay, 145. Just a sec. What was it for June 13th? 140. Okay, 147. It's exactly the same. And I'm going to go out 30% longer. And so this is the way it's like, I say nay, nay, to quote John Panette. It's like, I don't think so. Like, so I know that there's more volume, so there's more liquidity. But this is a pretty heavily traded stock. And so the thought process might be, I'd rather do one that's 3 weeks long, time decay is going to be more accelerated, and then I can get out of that and do a wash, rinse, repeat. So we're going to go with the June 13th, and that's the reasoning behind it. And sometimes, you might check and there's enough extra premium that make it worth going out further. Or maybe the bid-ask spreads on the weeklies are just so bad, they're just too wide and it's not a possibility. But in this case, they're 35 cents on a $10 option. So we're good to go. So we're creating an opposite order. Hey, when this is worth 30 cents, 29 cents, you know, when we've got 80% of our max gain, we're just going to buy that back. Okay. So that's Goldman Sachs. The wash, rinse, repeat continues. Now I want to just take a hot sec to come and look at a trade that we already have in our account. Okay. So let's put this one in. And how much are we risking? 353. Is that under 500? Yes. And this is our theoretical max loss. How much can we make? 147. Okay, a short, a put, a vertical. There we go. Okay, so let's come and look at CELH. Buy right covered calls. So here we have Celsius Holdings. We bought 100 shares at 37.29. Okay, and just let me look at my notes on this. And prior to this, it's showing that we're up by, or down by 56.50 on this net. But prior to this, we had collared this position. We sold a covered call, bought a protective put, and we netted $100 on that. Okay. And then last week, we sold a covered call here for $1.16 a share. And it's now trading at 34. And so we're up 81.50 on that. And so if I come out and say, okay, if I buy it back, it would cost me 34.50 to, well, let's do this. I'll put the dot in there, our decimal, 34.50. And if I divide that by the 116 we were paid, that's like we've got 70% of our max gain. So let's come and look at Celsius. And I'm just trying to share some ideas on how traders might look at this. So this was going sideways. It broke out. Old resistance now acting as new support. And today it's bouncing. And here's our covered call up here. So maybe we buy the covered call back here, take the 70% of our max gain, and then if and when it comes back up around here, we sell another one. So we could do a wash, rinse, repeat kind of strategy with this buy right as well. And so if we come to our monitor tab, we have an exit. If we look at our working orders and we come down here, what's our exit? And let's not change our exit, fuss with that today. So our stop is at 31.52. So I'm just going to make a note of that. Our stop, 31.52. And what we're going to do, because this is to close out the entire position, we're just going to cancel that. So now that we canceled it, we can come back to Celsius and say, okay, baby, we want to just buy back this call that we sold and take that unrealized gain and turn it into a realized gain. Maybe we could do that for 35. And then the intention is when we meet next Wednesday to maybe sell another one if it's, behaved as we would ideally like it to behave and moved back to the upside. Okay. Now we have another buy right that we did last Friday where we bought 100 shares of Rivian and we sold the covered call. And so we could come and look at this because here, this candle, this doji pattern, and these might be, the dojis are on my list. They're going to be, 2 of the next 4 that I do for those little mini sessions. This actually requires confirmation that we're finished falling, but, this expires June 6th. So we have 2 weeks to go on this. Could we maybe buy this back or do we just let it ride? So let's come and look at Rivian. Well, you know, we're up a few bucks here. We did 3 contracts, so we're up $50. It's not nothing. But, you know, if it continues to fall because we don't have a confirmation pattern, you know, could we exit? The stock is basically trading at the same price it was a week ago. It went up dramatically and pulled back. So this one we're going to vote on. Okay. So I'm going to start a little poll, and it's like, Rivian, do we buy back the covered call with the intention of selling it again when it bounces, if and when it bounces? So I like to run a semi-democratic class, so you can go ahead and vote, and we'll go with whatever the majority decides. Because full disclosure, I've kind of gone back and forth on that one. And in the meantime, we'll look at another potential opportunity. Okay. So let's come and look at, I've got 3 others that I thought we might want to have a little gander at. And Microsoft is one of them. So, you know, this is obviously not a startup. Microsoft has been around for a while. And, you know, it was kind of on the struggle bus there for a while, right? Like really from December of last year, it had been falling. And like so many other stocks, on April 7th, it hit its bottom. And man, on the last earnings, I mean, it must have had some pretty amazing forward guidance, because that's a big move. And then it just kept on running. And it's now come back above this former resistance level that it hit at the end of January, and is coming back to retest. So if a trader was thinking that this might hold, they might say, well, could I come out and sell the 445? And again, why might we consider this when it's a down day? Well, we had this, you know, doji pattern, which might have indicated that, you know, is this downturn coming to an end? And then it fell again today, but it opened lower. And like so many other stocks, is the bulls are trying to come in. Okay, so could we just look at that? And again, it's a little more aggressive entry. And if we come out to this 3-week 445, we have a 15-cent bid-ask spread, obviously lots of volume on the stock, hundreds of contracts here. What would we get? $1.40 versus $3.60 that it's going to cost us. $1.40 is our, you know, theoretical max loss. So that's a 38%. What if on this one, what if we went to June 20th? Okay, $1.40. Oh, you're going to give me a nickel to go out a third as long? Yeah, I don't think so. I'll stick with it. Now, what's the disadvantage of just being 21 days is that if it goes against us, we don't have as much time to recover, do we? We don't have as much time to recover. But, you know, if we're thinking, we think this support level is going to hold, we wouldn't place the trade if we didn't think that support level was going to hold. We're going to do 1 contract, because 2 contracts, we're risking too much. We're risking more than we have agreed. And that's a rule we don't break. We're not going to risk 600 and what, 360? So that would be over 700. Yeah, we're not doing that. So, you know, and there's a transaction fee. But, you know, most we can make 140. We're saying, hey, if we can make like 110 of that, we're happy campers. Base hit. That's what we're looking for. Put that in our short put vertical group, fire in the hole. Now, we have reviewed all of the trades that we got out of the postmortems. On our vote, we're at 60% have said, let's close out the Rivian call. So, oh, and we haven't got into Celsius. So we haven't, let's look at that. Okay, they only want to give us 33. So let's, okay, be like that then. So hopefully that'll fill, and then we'll put that stop back on. And then on Rivian, we're going to come down here and do the same thing. We're going to look at what our stop was. Our stop, 1379. So we'll just leave that in the same place just for speed of execution. I'm not saying you shouldn't look at it. I'm just saying we're not going to, in the interest of time. So we're going to cancel that. And then we're going to come down now to this position on Rivian, and we are going to buy this back. It was 58, so it's pulling back a bit. We're going to create a closing order. Oh, no, we don't want to do that. We just want to buy back the call. So we just want to buy back that call. And let's see if we can do that at 56. Okay, and I'll make sure those get filled, and I'll put those stops back on. If you wanted to do some additional practicing before the long weekend hits, could you look at a Netflix for a similar type of setup? Yeah, you could. If you just wanted to practice, or could you look at a Carvana? Like that one's even more bullish, isn't it? Because we do have, if we look at maybe, and we have time to just do one more quick trade here. So we did have this inverted hammer and then a bullish engulfing pattern, and then it's continuing to move to the upside. So, could we do, this is at 305. Could we do a 290 strike here, or even a 285? So if we look at 290, and again, $1.50, $3.50 we're risking, that's about a 30% return. Single order, first trigger sequence, right click, opposite order, and we're going to buy it back for 30 cents. That's the intention. Doesn't always go according to plan, but that's the intention. Confirm and send. And we're going to put that in our short put vertical bucket. Okay, so guys, we have fit a lot in today. We've reviewed the 6 trades that we ended up out of. We did a detailed review on Super Micro, SMCI. We also looked at a couple of our buy right positions. We looked at the one on Rivian and on Celsius Holdings. We had a quick look at McDonald's, our Mickey D Iron Condor that we're partially legged out of. And then we have placed several new trades, one on Palantir, one on Goldman Sachs, and we have 2 pending on Microsoft and Carvana. Today was short put vertical day. So I hope you found this helpful and informative. If you haven't hit the like button, it helps move this up in the algorithms so that more people can find this content. It also lets Connie and I know that you found this helpful. Subscribing to this channel is free, and we encourage you to do that if you haven't done that already. Follow us in the Land of X, Barb Armstrong CS and Connie Hill CS. And if you could do us a favor and go and just respond to something that we've posted today, that would be fantastic. For me, if you'd respond to the one on the long weekend, because that one, I put in a new parameter to try and block the spammers. So I'd appreciate your help on that one, just to make sure that the right people can get through. So guys, get out there and hug someone you love. I hope that you have a really great weekend. Thank you to all those that have served and their families. This is a good reminder for all of us that freedom is not free. free. And I hope we take a moment to pause and reflect on that as we go through our weekend as well. Take care, everyone. Bye for now.